Thank you. And welcome to the latest Wintrust Private Client panel discussion on the economy and financial markets. My name is Tom Zidar, and I head up the wealth management group here at Wintrust. And I'll be moderating our discussion today, which will focus on the Fed's monetary policy, the health of the U.S. economy, and implications of the upcoming elections on the markets, the economy, and taxes. Before we begin, however, I unfortunately have some tragic news to share. Dan Rahill, our wealth strategist, who is to be part of today's panel discussion, passed away unexpectedly over the weekend. Dan joined us in October of 2019 with just a wealth of experience in the financial services industry, including 28 years at KPMG, where he served as a managing partner and trustee of the KPMG Foundation. He held a long list of degrees and certifications. He was a lawyer at JD, CPA, LLM, PFS, CGMA, and was widely sought out for his expertise and was a frequent contributor to the media outlets here in Chicago at the Tribune, the Sun-Times, Crane Chicago Business, ABC7, NBC5, WBBM, WGN, also nationally with Yahoo Finance and Bloomberg. In his 5 years here, Dan worked closely with many of our Wintrust colleagues and their clients. In fact, some of you in the room here tonight. Dan tirelessly answered tax questions. He generated creative trust and estate plans and structures, and he consistently delivered thoughtful insights and sage advice. He was brilliant, enthusiastic, energetic, and a wonderful teammate. Nobody, and I do mean nobody, got more excited to talk about taxes than Dan Rahill. Dan will be sorely missed. Please keep his wife, Christine, and his 4 sons, Daniel, Patrick, Kevin, and Colin, and the rest of the entire Rahill family in your prayers. We've kept a chair here tonight just in Dan's honor, and I'd ask you now to join me for a moment of silence in Dan's honor. Thank you. But Dan would want the show to go on, and it's going to go on without him. And I'm really pleased to be joined today by longtime panel participant Jason Turner, who is the Chief Investment Strategist and Head of Multi-Asset Strategy for us at Wintrust Wealth Management. Welcome again, Jason.
Thanks, Tom.
Good to have you. And we're thrilled, too, to have today Dr. Jeffrey Roach, who is the Chief Economist for LPL Financial, where he is responsible for relating economic conditions and financial market outcomes. If you're not familiar with LPL Financial, it is a national independent broker-dealer with a world-class brokerage and investment advisory platform with more than $1.3 trillion under administration. Wintrust Wealth Management will be partnering with LPL starting in January 2025. In his role at LPL, Jeffrey maintains frequent contact with the Fed and their economists there, Wall Street analysts, and other leading global money managers. He is an active contributor to the financial press and is sought-after speaker. So we're really pleased to have him with us today. So welcome, Jeffrey, and thanks to you and Jason for being on the panel this afternoon.
Thank you.
All right, let's start with the Fed. We're going to jump right into it, guys. The next Fed meeting is November 6th and 7th. Jeffrey, I'll start with you. What do you think they're going to do and why?
Well, first off, let me just say thank you. It's fantastic to be in an incredible building. This is a lot of fun talking economics, and this is what I get to look at. So thank you. Thank you for the opportunity to be here. But yes, interesting times. Really, things haven't really slowed down much, since COVID reopenings, shocks here, shocks there to the economy, wars overseas. The Fed's got a tough thing going right now. They have to be data dependent. They have to be consistent with both sides of their mandate. By the way, I don't know if I'll try to channel my inner Goolsby. He's got a great voice, for one thing, and he's entertaining. Goolsby member, the voting member of the FOMC. So since the early 1900s, Fed's got to manage both mandates. And for those that aren't geeks like the rest of us, the two mandates are, and they seem to be in tension with one another, price stability, the inflation component, and then full employment. So you got the inflation side, you got the growth-oriented side. And so I'm showing on this graph that's shown behind me two lines. I'll make it simple. Blue line is the CPI year over year. You can see that labeled. Orange line is that Fed funds rate. The Fed has this luxury, if you will, able to ease up on their upper bound at this time because there's such a gap between that nominal Fed funds rate and the inflation rate. Inflation is still very high. It's too high. Price levels, if you think about our end clients, price levels is what hits people's pocketbooks. But in terms of policy, they look at rates of change, just the growth of things. Inflation's easing, low enough for the Fed to have a little bit of leeway. We think there's a cut happening in November and December, so 25 basis points, which is another way of saying 1/4% right. In both November and December. But it's not 100% done deal kind of thing.
Yep. And it's changing every day as we watch the markets. Jason, would you agree with that forecast?
If the question is, what will the Fed do? I would agree with the forecast. The Fed is most likely, and it's for the November meeting, 85-15 this morning. We talked yesterday, it was 90-10. Highly likely the Fed is going to cut 25 basis points in November, and again follow that with 25 basis points in December. Now, if we extend the question to what they should do, there I'll deviate. And I think if we took this chart and we layered on a few other lines, and those of you that have seen me or had the unfortunate incident of seeing me present recently, the inflation chart I've got has 4 or 5 lines on it. And we look at things like super core inflation or sticky price inflation, these other measures of prices of things that have gone up and stayed up. And there we're looking at numbers in the 3.5% to 4% range for inflation. With the Fed funds effective rate about 4.8%, that creates a lot less space for the Fed to cut and make additional cuts before they get to, let's call it a temporary neutral, until those areas of hotter inflation, like supercore, start to abate over time. So I was even a little surprised that they started with a 50 basis point cut, to be quite honest, in September. Some of my team is in the room, and they heard me pontificating that morning about the reason the Fed is going to cut 25 basis points, and lo and behold, I was made wrong 2 hours later.
Yeah, it was actually kind of scary, right? I mean, everybody expected 25 basis points. It was sort of like, what do they know that we don't know? But things have stabilized since the 50 basis point cut, Jason. But I'm going to stick on the inflation question. You have educated us in the past about PCE, Price Consumption Expenditure Index, and that's the sort of the preferred inflation measure of the Fed. It's down to 2.2%, very close to the 2% target. However, the core PCE is 3.7% now, so it's still not quite there yet, but trending in the right direction. So Jeffrey talked about the dual mandate. Is inflation still the primary concern of the Fed at this point?
I think the Fed is pretty clearly articulated from approximately the July meeting and certainly from the Jackson Hole meetings in August that the primary focus going forward is the other side of the mandate, as Jeffrey articulated.
Yep.
That they're more focused on the employment side, and certainly the employment reports we initially saw in late summer reinforced that thought, that the unemployment rate was creeping up, the stability and decline in the headline rate of inflation we've seen seems to put it on a persistent path to 2%. And despite my concerns that maybe inflation is higher than we might think relative to the headline CPI, yes, the Fed uses an alternative measure. They use PCE. They like that measure because it's not as dominated by things like shelter. It shows really more the real impact to individuals, particularly the core PCE measure. Now that measure's not back to their target yet, and they don't have to wait till it gets back to their target. They have to wait till it's on path to their target. But in my estimates, I don't think on its current path, core PCE gets back to the Fed's target until late 2025 or early 2026. And if that's the case, we may be a little early in terms of the cutting cycle.
Yep. Jeffrey?
Yeah, just to add something, thinking about the various metrics of inflation kind of, I think, begs the question, why are there so many? And let me just highlight that I think in this post-COVID world, we're basically always reminded of the difficulty in looking at things in aggregate. right? So to say, okay, inflation is this for this group. I like to tell people, I was at Visa before LPL. So when work from home happened, we moved back to Charlotte, North Carolina. That's where family and friends are. And this was late 2020, early 2021 to make that transition. I like to tell people my inflation rate, my personal inflation rate, moving from Silicon Valley to Matthews, North Carolina, a suburb, to put it, conservative, maybe negative 1,000. So when you think about these scores of millions of people that had really dramatic shifts, it reminds us the difficulty of just data measurement and talking in aggregate, because it's so very different. Services industry kind of people that have the ability to move around, hybrid, those that are restaurant ownership, et cetera, they don't have that ability to move around from a high cost of living area to a low cost of living area.
Like people working in banks, is that what you're saying? No, good point. And on the inflation front, Jason talks a lot about commodities, and we've seen inflation, drive higher the price of number of commodities. Gold specifically, Jeffrey, I want to ask your perspective on up 38% year to date. Quite a rally. How does this, what's your take on that? What's driving it besides the obvious? And does this have any impact on not only the U.S., but more, sort of global ramifications?
So gold's an interesting commodity because normally, traditionally, those that have been around the business for a while, we think, okay, gold exists as a hedge against inflation.
Correct.
So, okay, that makes sense when you have an inflation problem. But as inflation decelerates, not falling per se, but decelerates, you'd think, okay, well, gold doesn't really become that glittery because of that reason. I think one of the things that could explain what's happening with gold is the fact that you have this really high correlation between bonds and equities. So for kind of your people that are interested in diversification, where are they going to go? You go to the gold dynamic. So it's maybe that alternative asset class for the portfolio. And then on top of that, you layer on, well, maybe it's a geopolitical reason. And that makes sense to me. But the challenge, of course, is it seems like particularly domestic markets, we've talked about this before we just got on stage, they seem to look past all the shocks. Russia, Ukraine, Silicon Valley Bank, all these shocks, and then Japan, a couple months ago. I think the gold story makes sense in that way. It's a buffer against the geopolitical risks that are out there outside of regular trading capital markets.
Yeah, absolutely. Jason, anything you want to talk about commodities besides gold or no?
We could stay here all night and talk about commodities if you all want to, but Jeffrey's observation on geopolitics being a driving factor behind gold certainly lines up with our narrative as well.
Can I jump in? I think, speaking of, we still have Q&A, right? At the end, we're going to have some Q&A. So, yeah, if we don't talk about something that's a hot take on your mind,
we'll have plenty of time for that. Great point. Speaking of inflation, as of the end of last month, the federal debt was at $35.5 trillion, which is considerably higher than our U.S. gross domestic product. Has become a real concern in the last several years. You have a nice graph here that's talking about, the debt levels as a percentage of GDP, I believe. Jason, what is your view on how important is this?
As you can see, there's two peaks in the chart behind me. Those two peaks are where we sit currently and the end of World War II. Those are the only two times the U.S.'s debt to GDP ratio has breached 120%. Just going to let that sink in for a second. Accounting for all of the war spending that won World War II is the only other time we've accrued this large of a debt burden in the United States. And yes, that has been growing since the early 1980s, but it represents quite a headwind for the federal government's continued intervention in the economy. We all experienced very directly and also indirectly, thanks to inflation, the effects of fiscal and monetary stimulus. And that fiscal stimulus, that $4+ trillion in stimulus we saw in the early part of this decade, largely drove us to where we are today. But now, as rates have come higher, the federal government has to pay additional interest on that borrowing. Anybody want to hazard a guess as to what the net increase in interest cost was from fiscal 22 to fiscal 23? It's about 0.4%. 0.4% of our GDP. So that's $23.7 trillion. Do the math for you, that's $90 billion in additional interest the federal government paid 22 to 23. That number is expected to go up significantly once we get the fiscal 24 numbers, potentially as high as 4 to 5 times. Now, on a go-forward basis, we're paying that much more in interest. That becomes a massive headwind to the federal government's ability to increase economic growth through government investment or government spending. And that represents a fairly large concern in the economy to me.
What do you think, Jeffrey? We hear about these staggering numbers, and obviously we're at a peak. How important is this? It looks scary on paper, but how much does it really impact, the U.S. and the world here?
Yeah, the two things I would add, I guess, to this is one is look at what happened in the late 90s and the fact that if you have some really solid pro-growth policies, you can whittle away a little bit of that, at least kind of reverse the trend. And pro-growth and the value of that really does filter through the debt component. So think 90s. I think the second thing to remember that kind of softens maybe a little bit of the, is this an Armageddon kind of risk? What's a little bit of a corollary to this is the fact that, really since the French prime minister said this in the 60s about the exorbitant privilege of the US dollar. So much is being traded in dollar-denominated currency. That buys us a little bit of time and softens a little bit of the blow just because of that exorbitant privilege that the U.S. Gets out of other.
So it's all relative, is what you're telling us. We're better than the rest.
Yeah. Well, the challenge is you don't know where the tipping point is.
That's right.
Right.
That's right.
Well, I think you expand the relativity too to those countries outside the United States. The UK is at 110%. Japan is at 254%. So we are not the global high outlier by far. And many of the economies that compete with us, China has gone up from about 60% to a little over 90% today. So economies around the world have seen a significant increase in the post-COVID world in debt to GDP ratios. And that, not that we all want to be in the same boat with that scenario, but that does represent a everybody's in this together approach for the global economy.
Good stuff, guys. So let's shift a little bit here to the broader economy. And given the Fed's own shift to focus on move from inflation to, as Jeffrey mentioned, the dual mandate of employment, let's talk about the U.S. labor markets. So Jason, what are the latest job reports telling us, and how would you characterize the health of the labor market today?
It's a great question. Characterizing the health of the labor market today, I would say the labor market is normalizing, or perhaps has now normalized. Let's put a couple things into perspective. First off, when we talk about full employment, when John Maynard Keynes first came up with the idea in his economic work of full employment, he said it was zero unemployment. Now, realizing and learning, as any good economist does as things go forward, we understand now, according to the Fed, that full employment is somewhere in the fours, somewhere between 4 and 5%. We go back a couple Fed presidents, we find a rate closer to 5, we find a rate closer to 4. Let's call it somewhere in the fours is full employment. Why? We measure unemployment on the 12th of the month. If you're unemployed on the 12th of the month, you're counted as unemployed. If you got a job on the 13th, you were not unemployed when we got the release. If you are moving across the country to switch jobs, if you are moving between industries, there will always be that transitional unemployment. So a rate at 4.1% that we find today is awfully close, or at least within that range of full employment, even though we've moved from 3.5% up to 4.1, or if we go back to the end of July, 4.3%. Now, that rapid change triggered something we call the SAM rule. It looks at the speed of change, both near-term and long-term, in those unemployment figures, and acts as a recessionary indicator. And you may have read things about that being an accurate predictor. the environment we find ourselves in is, in my mind, altogether different from prior periods. We're not talking about a move out of the 5% range to 6% triggering the rule. We're talking about a move from somewhere beyond full employment. The other unique thing we've seen in labor markets is a normalization of job openings and total unemployed persons. And that's the other lines you see behind me. We have about 6.5 million unemployed here in the United States. We have about 8 million open jobs. Now that number was as high as 12 plus million open jobs and just 4.5 million unemployed a few years ago. So that normalization in markets where we have seen numbers that were away from equilibrium, and we economists, we like to talk about equilibrium and supply and demand. And supply and demand in the labor markets appears to me to have normalized. This appears to be a safe spot for labor markets on a go-forward basis. And thanks to recent revisions, we're not seeing rapid change that would indicate we're moving to tougher economic times.
Jeffrey, would you agree?
Yeah, well, so I think it goes back a little bit to what I mentioned earlier, where the data measurements are a little bit of challenge. In fact, when openings, you see that spike in the chart. When openings spiked and then kind of stayed elevated for a while, I actually called our HR people. I said, okay, tell me, how do you report this, and what are you doing, that kind of thing. And I realized, it's funny, sometimes those openings are not fully funded until sometime in the future. So you might have an opening, here we are, October, mid-October. Maybe it's not gonna be, funded from the corporate side till January, but they wanted to start looking, given the fact that we all know businesses are having challenges finding qualified workers, right? We know that from the NFIB surveys, a number of other Fed surveys. And that gives me a little bit of pause. And so what I said, all right, let's do a couple slice and dicing. Take out the massive hiring from state government. So, you can break out federal, state, local, of course, within that jobs report, if you're a geek like us.
Yeah.
Massive increase in state hirings. I just look at private and realizing that there's still a little bit of this kind of finding our balance, if you will. And I think that's perhaps maybe why the Fed legitimately saying, okay, we think we have inflation decelerating. We think we do have some uncertainties in labor market, and so we can kind of pivot and shift toward that side of the mandate.
Right.
Conference Board, for example, has some interesting data that suggests that consumers are just finding it harder to get those jobs, even though you might see this massive increase in openings.
Yeah. Well, you talk about the Fed and they're so data dependent. It's been interesting to see how many revisions we've seen to the numbers of late, from job reports and others as well. But, why is it that we're seeing so many of these revisions, and is there concern then about the strength of the labor market?
Well, I think it is fair to remind folks, economic data is very different than, say, fundamental bond and equity market data, right? You can measure PEs and all the metrics and ROIs. This side of the ledger, if you're looking at the macro side, a lot of times you're just dependent on businesses turning in their surveys, right? Okay, how much do we increase our payrolls? What are we paying? What are all those details that businesses turn in voluntarily? And as time goes on, as we all know, right? We all know about how we do with deadlines. Sometimes we don't meet them. And so the government, whether it's the Bureau of Labor Statistics, the Bureau of Economic Analysis, or the Census Bureau, they say, hey, we need your data by, this date. Well, as more and more surveys come in, they respond and they revise data. We haven't seen this magnitude of revisions, I don't think, ever. Particularly not just in labor market revisions, but in income revisions. So I'm showing you on this graph something that really kind of was a light bulb for me, realizing, okay, why is it that we have such strong, resilient consumer spending given other headwinds? And I think this explains a lot. So this is the gap between that orange line and the blue bars is the gap that illustrates the additional amount of income that was earned each month. So think of that cumulative area that wasn't captured the first time around. This is year-over-year change in disposable income on the consumer side. So consumers are making a lot more money than we originally estimated, even in the last year or so. So consumers are pretty decent footing, especially if you don't have a mortgage, or if you have a fixed rate mortgage.
From a while back.
From a while back,
Right.
you're able to say, all right, we have this amount of earnings, and certainly portfolio values have gone up in the last little bit, and that's spurring the spending right now.
That's helpful, and so it suggests maybe a stronger labor market than the initial readings would suggest. So, so Jason, in that light, as you look across the U.S. economy as a whole, do you believe we're on the path now, in light of the Fed's move, for a soft landing, a hard landing, no landing? What kind of landing are we going to have here?
Interesting that we've put aircraft terminology to the economy. It's soft, hard landing, no landing. I think with the near-term data revisions now kind of better understood by economists and a good viewpoint going forward, and I'll couch this with the disclaimer that often the Fed either overreacting or reacting too late is a catalyst to a cyclical change. With that outside of the arena, the path to a soft landing appears fairly straightforward in front of us. Now, it's fairly narrow. Jeffrey pointed to this earlier. I'd equate it to the Fed is walking a tightrope. That they can't err too much on one side or the other to be able to engineer this soft landing. And recall in the last 60 years, the Fed has really only achieved 2 soft landings, one in the 80s, one in the 90s, and is intended but missed those soft landings in other cases. I think the other thing that the data revisions have started to provide for us is clarity that 4 months ago, we thought all of the risks were left tail risks, where we were going to see inflation go well below the Fed's 2% target. We were going to see this sort of scenario emerge where they needed to maybe spur economic growth a little bit more. We're starting to see some on the opposite tail emerge, where there are some legitimate cases where inflation remains hotter than expected, or the Fed's early action and strong action in this cutting cycle spurs additional inflationary impact. So if we look at those as scenarios, the chances for a hard landing or a no landing scenario, and I would consider both of those risks. No landing is not a Goldilocks scenario. No landing is not, we're going to grow at 3.5% like we did in the 1980s with minimal unemployment without a problem. I think F.A. Hayek would tell us that the real cost there of all that extra growth is just devalued capital, or said another way, additional inflation. So that's the risk on the no landing side. So a narrow landing strip, a narrow and maybe short runway to achieve that soft landing, but that's the most likely scenario right now for me.
Got it. Jeffrey, how about you?
Yeah, I'm with you that the aircraft is not really the best way to think. I think of it like a runner, right? Sprinting, the kind of where you are in the stage of the race, and it's about, are we going to be, running hot above trend? Are we hitting trend growth, or are we going to get dramatically below trend growth, or even negative? Interesting, we haven't talked about this yet, but we had a little bit of a head fake in 2022, right? So we had 2 consecutive quarters negative growth. Of course, markets didn't know what to do, and we saw that sell off, October 2022. It is important. I say this to my mom, and she's trying to figure out what's happening. A non-technician. It's dangerous to say recession is 2 negative quarters, because what happened in 2022, case in point, is it was inventory adjustment and trade, but consumers were still going great. Right. Hence, no recession in 2022 because some areas of the economy are doing so well. And of course, my mom says, okay, if you can't do 2 negative quarters, what is a recession? You say, well, you got to appreciate, those at National Bureau of Economic Research. I think of it as the 3 Ds, right? Depth, diffusion, duration. So you have to have a deep enough decline, has to be diffused across broad sectors of the economy. It can't be inventories and trade. Depth, diffusion, duration. It has to be long, more than just a couple months.
You have some interesting conversations with your mom.
I feel bad for my kids. I have 2 teenagers. They have to put up with all this stuff, and that's really the sad part of it all.
This is for both of you guys. We're generally very U.S.-centric in how we talk about all these things. Anything from a global standpoint that you're concerned about, any economic weakness or the like that really could adversely affect the domestic economy that we should be on the lookout for here?
I think we've seen geopolitical issues arise in the last several years, and we have seen, as Jeffrey pointed out, we were talking about this right before we came on stage, those geopolitical disruptions, whether they be the conflict currently in the Middle East, or whether it be Russia's invasion of Ukraine, or an economic shock like China's experienced in their property markets, we may get an initial knee-jerk reaction in U.S. markets. I'll go back to early 2022 in the Russian invasion of Ukraine. We saw about 3 or 4 days of real market disruption. The stock market really took a dive. And then over the course of the next 2 weeks, the market recovered entirely. The market does a good job of pricing in the future, and that, I'll go back to your French president quote about the resiliency of the United States, a great privilege of the U.S. economy. We'll expand the dollar to the economy. The great privilege there is that the American economy stands on its own 2 feet, largely without impact from the rest of the globe, particularly as we've seen this deglobalization trend over the last 5 to 7 years.
Yeah, I think when you think about where the risks might filter and spread out, the risk of contagion. I go, as you're talking, my mind is going back to, pre-Great Financial Crisis. Remember the Greek shock? We got the Greeks so over indebted and they're starting to default, and you're thinking, okay, Greece. I mean, beautiful architecture, but what does Greece have to do with London markets or New York Stock Exchange or Chicago board? Well, and lo and behold, it did just kind of, the contagion was there. So I think, where we all sit, okay, where are the risks? Well, you look at those beginning signs of the contagion. That's where you start thinking, okay, that's a real risk.
And contagion needs connection. So your Greece example is a good one. The contagion from Greece was that Greece was part of the euro, the European Economic Union, and those other countries in Europe needed to turn around and bail Greece out. And that really caused that contagion to be something shared by the entire continent as opposed to just one nation. You look around the world at things that could do that now, and those tend to be financial market type situations, less so geopolitical and military conflict situations. But those financial market contagions could find their way into U.S. impact. You look at things like China's property crisis. If their stimulus efforts were to fail and they needed to tap into those vast reserves of U.S. treasuries to boost government spending, then we're talking about maybe changes to the U.S. markets.
So since we are going dark here,
this is quite the what if scenario too.
Well, long term, I think it is helpful. I mean, for all of us, right? When do we know when markets are going to be at a teetering point, or just the risks of the macro environment? I mean, think long-term capital management. The late 90s. The challenge was it had so much leverage from the banks, and that leverage was kind of where things kind of connected. So, connectedness, contagion. That's excellent.
All right, I'm going to shift our discussion to Dan's favorite topic, which is taxes. There's a great deal of potential change coming in the next 15 months, starting with the tax provisions from the Tax Cuts and Jobs Act of 2017 that are set to expire at the end of 2025. Both of you guys can answer this. What are the top few provisions in your view that individuals and business owners need to potentially prepare for changing at the end of next year?
Well, from an individual perspective, it's a change in the top-end tax rate. That one is fairly straightforward. We all know the rate used to be 39.7. Now the rate is slightly lower. That will revert up. For business owners, similarly, there is a change in tax rate and a change for taxation for S-corps and partnerships that will roll out when that act is sunset. Also, on the flip side, those SALT deduction limitations that limit SALT deductions to $10,000 would be another one that will now sunset and come out of the law.
Yeah, and see what happens with bonus depreciation too. That was one of the things. I remember history is important, right? Know your history. 2008. So one of the stimulus responses during that time period was bonus depreciation. That tends to be pretty effective, particularly for businesses, right? Capital expenditures. So bonus depreciation will be another line item you want to watch.
Yep. And Dan would have reminded us about the estate tax level basically being cut in half, conceivably at the end of 25. So that's a big one for a lot of our clients. Clearly, there's a potential for change will depend on the results of the election. In addition to the presidential election, we have 33 Senate seats and 435 House seats that are up for election just in the next month. How might the various outcomes affect the likelihood of the 2017 Act provisions actually expiring? Who wants to take that one?
Well, that's the political hot potato.
Yes.
How might the outcome of the election, and we can talk about different election scenarios, whether they be a red wave or a blue wave or some sort of divided control of either the houses of Congress or between the presidency and a different party controlling both houses. And you can see behind me, there's a myriad of different potential outcomes. I will point out the word certain does not appear in any part of the table. And that's one thing we can count on from our friends in the federal government. There is no certainty. As much as markets might like certainty to determine which direction they may want to go, the odds of us seeing major year-end tax changes, a straight extension of all of those Tax Cuts and Jobs Act provisions is, I would say, very unlikely unless you get a clean sweep by either party. And right now, if you look at betting markets, the more likely clean sweep scenario is the Republican clean sweep as opposed to the blue wave that we talked so much about in 2020. But as we move towards the middle, as we move towards the more likely scenario of split control of Congress or differing control of Congress and the presidency, you're seeing some possibilities. And I think what we should all take into account is, number one, both candidates have indicated that they want to extend some aspects of the Tax Cuts and Jobs Act. I think they both realize that with the extended level of federal debt, the federal debt burden doesn't really line itself up with extending everything. So they need to pick and choose. And those pick and choose items will obviously lead us into different conditions, whether it's a Democrat or Republican in the White House. But the control of the houses of Congress likely leads to the same lack of across the aisle, let's make a compromise scenario that we would like to see out of an extension of tax policies.
Agreed. Jeffrey, anything to add on the tax front?
No, that's good. I think there is a move to the middle, which I think is very indicative, kind of reading between the lines, right, of where both campaigns are feeling, how confident they are. Now, maybe perhaps how tight the race actually is. Both are moving to the middle on that start.
Yeah, speaking of both moving to the middle, the top of the list is the corporate tax rate that's been debated back and forth. Can you just, I guess maybe look it up and down. What are the ramifications of a change on the corporate tax front?
Well, generally, markets are going to dislike the idea, particularly equity markets, are going to dislike the idea of an increase in corporate tax rate. Why? It goes straight to the bottom line. The corporate bottom line will be impacted by the higher expense item of corporate taxes. The longer term implication is that businesses, provided they have the space to do so from consumers, will raise the top line, will raise their prices to accommodate that higher tax provision and try to protect those earnings on the bottom end. They'll be able to do that to the extent the American consumer remains robust and the economy remains at or above trend growth rates. If the economy remains strong, corporate taxes are a short-term disruption to an increase in corporate taxes is a short-term disruption to markets. If the economy falters or weakens, that is a longer-term headwind for equity markets. So it largely depends on the health of the consumer.
Yeah, and actually one extra thing too is think of on the corporate side, what we're seeing really in the last 18 months, businesses have had some level of price setting, the ability to just have a little more control over that price setting. And that's certainly going to be important if they can maintain that ability with the strong consumer, then maybe they work through, that short-term disruption, for sure.
Let's stay on the markets because the equity markets have been on a tear lately. As we've seen, the S&P 500 has posted its best year-to-date return through the third quarter in 27 years. Beyond the specific tax impacts that we mentioned, what might be the general impact on the markets if we have a red or a blue White House? Jason, I'll start with you then.
Well, that's the, I guess, the question of the day.
Yep.
Certainly the question I get every time I'm in front of groups. The market's reaction is the market would prefer the federal government stays out of its business. The market likes two things. It likes stability and it likes certainty. And stability means we don't have changing tax law, we don't have changing regulations, we don't have a shift, whether that be a shift to the right or a shift to the left, in terms of the policies it has to account for and predict out into the future. So you can see in both cases a divided control situation, whether that's a Democratic president with a split Congress, a Democratic president with a Republican Congress, Republican president with a split Congress. Those scenarios all perform best for the market historically in the year after the election. Why? Again, you get little to no new major regulations passed in that type of scenario. So the market can put the federal government out of sight, out of mind, can concentrate on company financials, reward those that are performing well in the current environment based on the economic conditions, and move forward. In those situations where you do have consolidated control, it's a lot more difficult for the market to navigate what could be a shifting landscape.
Yeah, or to put it simply, the market doesn't care. The market is often up. Whoever's in the White House, right? I mean, that's kind of the whole point, particularly those in the middle of those.
Yeah, those are all positive numbers.
Yeah,
so.
Yeah,
exactly.
That's right. And so to that point, what's maybe more important versus the election winner is really where we are in the rate cutting cycle. And so that's something I think we have a slide on here, but can you guys speak about why that really drives things probably more so than who wins the presidency?
Of course. And if we were to put up a chart here that listed asset classes or listed maybe more accurately sectors of the S&P 500, let's go back to the 1990s and show red and blue boxes for which performs well or performs poorly. There is not a single solid line on that chart. That is a mix of reds and blues. Why? Because it really is the economy. It's not politics that drives the market, it's the economy. And you can see here investment performance after a rate cut. Now I will provide yet another disclaimer and try to help you understand what you're looking at. Generally, when the Fed is cutting rates, the Fed is cutting rates to spur economic growth. Why? Because economic growth has slowed. Generally, that's a recession. In fact, the last 3 times the Fed started with a 50 basis point cut in a cutting cycle, 3 of the last 4, we were already in a recession. They start with that 50 basis point cut because they're reacting to something. In that type of scenario, stocks tend to be a little more volatile in the run-up. So you can understand why the S&P 500, particularly in the 3-month window here, significantly underperforms fixed income. Now, I don't want to discount the fact that a falling rate environment is great for total return bond investors. Bond math is upside down. One of our chief investment officer for our fixed income teams here in the room, he will chastise me if I don't give you the quick bond math education, and that's simply yield down, price up. So if you're a total return bond investor, you own bonds in an environment where yields are falling, the price of those bonds are going up. If you're concerned with the total return as opposed to the coupon payment, you get returns like these in the Bloomberg Aggregate Bond Index. Now, taking that into account and comparing and contrasting that to the equity markets and where we sit today economically speaking, I would not be surprised to see equity markets on top of bonds a year from now, but I would be shocked to see bonds deliver a negative return in this environment.
Yeah, and I think this chart shows that to some extent. Jeffrey, can you explain this one?
Yeah, so you hover around your 1995 section of that chart. Basically, you think about this. If the Fed is cutting because inflation has become less of the monster in the room and they can think about other aspects of how the cycle is going, that's going to be great for markets. And that's exactly what we're seeing right now.
Right.
So we're not seeing, massive stress in credit markets. It's not like '07. I started my career in the Bank of America trading floor, Charlotte, 2004. My first project out of grad school was these weird acronyms. Hey, can you tell the traders something about CDOs and CLOs, subprime mortgages, all that kind of stuff? You don't have that going on at the same level now. So, do we repeat that 90s scenario? It's possible. Fed cuts because inflation's less of a problem. Markets rally because of that. Hence, we might actually continue to see some appreciation in equity markets.
1995 was one of those two soft landings I alluded to earlier. So you can see the actual market results there plainly on the screen.
Yeah, good stuff. So rate cuts not associated with recession. Actually, the picture is not so bad. Okay, guys. So let's last section before we open it up to the audience, and really it's more practical implications for our folks here in the audience. What do we do about all this? Is sort of the bottom line. With all the potential change coming, we recognize that we're living here in interesting times. How do you counsel individual investors? And Jason, I'll start with you in terms of all of these various scenarios. What's your advice for the typical investor out there? How do you handle this environment?
Sure, interesting times indeed, and I think that's one of the colloquialisms that you think is maybe more of a veiled threat than it is an encouragement. But certainly interesting times. Interesting times meaning volatile times. We've seen this if you just look at the performance of the bond market, the yield ebb and flow in the bond markets. And we went from higher for longer last fall. The idea that rates were high, we were going to have to hike rates 2 more times to get things to get inflation under control. We flipped that around by January the next year, 7 rate cuts starting in March. We gradually whittled away at that 3 to 2 to 1, maybe 0. Okay, we get some employment reports at the end of the summer, and now we're going to have 100 basis points of cuts by the end of the year. That ebb and flow, and I shouldn't call it ebb and flow, that sort of roller coaster ride on the long end of the bond market, and we've seen that long end of the bond market tick up most recently. It creates a lot of consternation, a lot of concern that as an individual investor, it's very hard to pick your spot. And there I would say, your best friend in these type of times, your best ally is number 1, time in the market as opposed to timing the market. And number 2, diversification. In these type of environments where you cannot accurately pick an entry point and a singular asset to beat the world, you are far better off as a long-term investor targeting a diversified portfolio that stays invested in the market. We can put all sorts of different charts up about the election. The one that will resonate with a lot of folks, if you just go to cash and wait for the election to pass and then jump back into the market, you lose every election cycle, every one of them. Yep. Staying invested even through the turbulence, but staying diversified is the right way to go.
All right, that's a great answer, but I'm going to come back and pin you down a little bit in
a
second, okay? Jeffrey, I asked about individual investors. We have a number of business owners and folks that are involved in all kinds of industries here. Can you just talk about, from a business owner perspective, what does this tell us and how should they be planning moving forward?
I think being creative and knowing how to capture the section of the market that's doing the best. In fact, I just recently did a piece on breaking out the spending behavior and kind of patterns by income and age. And it's the high earning millennials that are kind of your sweet spot. And I think, I think learning how to know your customer even more, right? That was one of Bank of America's mantras they kept on putting as know your customer. And being able to pivot as your market pivots. I think Dick's Sporting Goods was a great example that big in the Southeast, not sure if they're big up here.
Sure.
But they're all about stuff, right? You go and buy your cleats and your glove and whatever. Well, in recent years, recent quarters, they've added a services component. You just don't buy a bike there. You can now get your bike serviced. I'm a big mountain biker. And so it's not just the high-end specialty shops, but having that ability to learn how things are changing and shifting, being able to capture that is certainly a great way to win in this environment. I was just going to add one thing on everything what Jason said. I like to remind folks, there's a difference between being a trader and being an investor.
Yeah.
The problem is your typical TV, financial news media TV is catering toward the trader.
Sure.
There's a very different dynamic.
CNBC audience, is that what you're telling me? Yeah. Well, I will go back to Jason. Thank you, Jeffrey. That's helpful. And so Jason, as you all have heard, on these quarterly panels, and he speaks to a lot of groups, is really our, investment strategist. But his day job is he is responsible for a couple of $1 billion of multi-asset strategies for our clients at Wintrust Wealth Management at Great Lakes Advisors. So Jason, you've been planning and doing things over the last quarter after quarter. How have you positioned portfolios in light of where we are in the rate cycle, and what are you planning to do as you look into 2025?
I think it's first important to note, as messy as this year has been, we took positions at the beginning of this year for a more volatile environment. We go back to the version of this panel discussion last year, and we were talking about that coming volatility and that we wanted to position for volatility. At the same time, we took steps in portfolios to position for a rate cut environment, knowing that wasn't going to materialize till later in the year in our estimates. If you ask me, I was still pegged to 0 to 1 cuts, so that's sort of how portfolios are positioned, but we reduced cash weights, for example, in that run up to what we've experienced over the last several months. That's largely helped to protect assets through these volatile times, but on a go-forward basis, we'll look to restate our capital market assumptions as we start to get some certainty about the path forward for the Fed. We didn't have real great clarity to that last January. We're getting better clarity now that the Fed has taken that first step, likely to take their second step in a few weeks. And as we move through the end of the year, we'll get a lot more clarity on where Fed policy goes. I think Fed policy is the #1 driver of markets from here going forward, and rates will have a large bearing. So where are we concentrating in portfolios on a go-forward basis? Haven't done all the work yet for where we want to be. We'll likely rebalance portfolios over the course of sometime in the next 3 months. It'll present a nice opportunity, as there's typically a nice amount of volatility and disruption around the end of election cycle. At the same time, in a falling rate environment, you look at areas that do well potentially as a proxy for rates that you can't get in fixed income markets anymore. And I'll go back to real estate and infrastructure as asset classes, two areas you've heard me talk about before. Real estate was the best performing asset class in our universe in the third quarter. Those companies typically have a higher yield, and that higher yield is more sought after in worlds where you can't get those yields in fixed income. And as I mentioned before, it's a great environment for a total return bond investor. For a total return focused approach, core fixed income we have been pounding the table in core fixed income since we reached that peak in inflation and started to come down the other side. It just presents to us a great opportunity for investors to take a measure of safety in an asset class that doesn't have a high amount of volatility and get probably a better than average return. And the last theme I would say could be prevalent within, I'll say, equity markets is a trend we saw slightly in the third quarter, and that's the unloved stocks starting to catch up to those Magnificent Seven. And whether that's the rest of the S&P 500 and maybe a little bit of an earnings catch up in 2025, or more resolutely, if we see the Fed on a concerted path to cutting rates, smaller cap stocks. Smaller cap stocks do typically perform better in periods of rate cuts, and they would line up well to perform in a scenario where the Fed continues its cutting cycle at, let's call it, an every meeting pace instead of taking a cut and taking a few meetings off and making a cut. So those would be the areas I'd be focused on, Tom.
Excellent. Jeffrey, how about from LPL's perspective, anything to add in terms of your portfolio construction sort of changes or thoughts as they look into 2025?
Yeah, we're kind of neutral on equities, kind of anticipating a little bit of that volatility. I think one of the things that we're really intrigued with is kind of removing this domestic overweight. We've been focused on U.S. markets for obvious reasons. We're kind of antsy, ready to look for opportunities. Obviously, we see it in some, India, for example. But we're thinking 2025 may be a year where we can start broadly diversifying even within the equity space. But yeah, core bonds hitting the table as well on that. And then just really saying, okay, we think there's going to be some volatility, but overall in a more strategic viewpoint, consumers looking pretty solid.
Yeah.
Yes, a slowdown, but not a recession.
Well, and that reminds me one more thing before we go to the audience. We talked beforehand, and you guys agreed earlier, probably 25 and 25 in terms of Fed cuts by the end of 24. But it seemed like you also agreed that we're probably 100 basis points lower if we look ahead, to the end of 2025. So, not maybe the rapid, number of cuts as we expected just a month or so ago. But I think there are ramifications in the mortgage market too, with mortgage rates. So we may want to touch on that for a minute, because we all talk about friends and saying, hey, well, should I buy a house right now? Should I lock in a mortgage? Or are rates going lower? And it's not as easy to answer, right? Because of overnight rates as opposed to mortgage rates. Jason, maybe you touch on that before we open this up.
Sure, and I think we've seen two camps emerge in terms of where Fed policy goes from here. It's the Fed just keeps the foot on the gas and not all the way to the floor with 25 basis point cuts until they get to where they want to go.
Yep.
Or they adopt an every other meeting cadence and they stretch it out over the course of every other meeting next year to get that additional 100 basis points in cuts they project. I've really softened on that view in terms of there being another 100 basis points in cuts behind these two. Certainly, you should have guessed that with my idea that 50 was too strong of a start, and maybe I would have taken November off if I was in their shoes. But if we do see the Fed even slow down a little bit, we have seen in the last few days, looking at where the yield on the 10-year has gone, what the market's likely to do. We've seen mortgage rates back up in the last several days. Again, just based on this idea that, maybe employment markets are better than the Fed thought. Maybe they don't need to be cutting rates right now. And if they don't and leave rates higher, let's say it's not a terminal rate of 3.5, let's say it's a terminal rate of 4, that's just 50 basis points. But we have seen that shift in mortgage rates that they might not come down as fast as we might be thinking. We might be thinking, in the old adage is that the Fed typically takes the elevator down and the stairs up, right? They cut quickly and they slowly walk their way up. They took the elevator up this last hiking cycle. They went up quickly, 4 successive 75 basis point hikes in that cycle. There's only one other 75 basis point hike in a 35-year window if we look back. I think it's the opposite. I think the Fed has taken the elevator up, they're taking the stairs down. And if they take the stairs down, I would imagine mortgage rates stay a little higher than people may have wanted or expected going into 2025. So if you're really looking for mortgage rate relief, you are looking for, unfortunately, maybe a worse economy. So the Fed has to accelerate their speed of rate cuts, and that's got implications on the opposite side of that home purchase decision.
But I think one way to say it is, instead of focusing on the rate side, hey, what's my payment going to be? Focus on the actual price levels for the homes. When are we going to start seeing a little more supply of homes on the market? And what's going to happen with, the potential for a first-time home buyer, support if we get that from a Harris platform. And so, look at that component instead of just your rates. But rates are probably not going to drop as fast as we would think.
I think the other observation I'll share from a behavioral finance perspective, and if you want to have some fun, read behavioral finance. It's what I do in my spare time. But the observation is recency bias. And we're all biased to the idea that we have lived through this decade of zero interest rate policy and the fact that 93%, according to Forbes, 93% of refinances over the last 5 years were at a rate below 4% into a fixed rate loan. That's not normal. That's not the normal world of interest rates. The normal mortgage rate is somewhere around 6% if we look at a 50-year average. And yes, that includes the early 1980s, but it also includes the zero interest rate policy period as well. So if we reset expectations to understand that a normal mortgage rate is somewhere around 6% for a 30-year fixed rate conforming mortgage, we can start to paint a little bit different expectation for whether we want to jump in with 2 feet. And I will comment to Jeffrey's observation that maybe we see some house price relief. Most recent data from Redfin shows that it's 19.5% of homes listed on the market have seen a price cut in the last 45 days. That's nationwide. Sure, it's localized to areas that did see much higher home price increases here in Illinois, but maybe we're starting to see some of those green shoots of sanity return to mortgage supply.
We still see a ton of all cash deals, though, and of course that's distorting a little bit. But I think that'll kind of ease up once we see a little bit of normalization.
Great. Jason, Jeffrey, thank you for your insights. And, that's the end of our panel discussions, but we'd love to open the floor to questions from the audience. So Hannah, I think, has a microphone. If you have a question, just raise your hand and she'll come by with a microphone. Right here in the front row, Hannah. Or third
almost
row.
front row.
Third row. Front occupied row.
The enviable position that we are in having the world's currency, how much risk do you see the U.S. dollar is on being taken over or being compromised by, say, the yuan or some other countries that are gridding together like BRICS and things like that? Do you see a major concern there?
I'll provide the simple one-word answer, no. The extrapolation would be, we have seen this time and time again with currencies, whether it be cryptocurrencies most recently, the Chinese yuan, the euro, the yen before that, if we go back to the 1980s, there was always going to be a next currency. The reality is that the world holds US dollars and US treasuries in vast quantities because they are the safe asset. And because our economy is so large and can support that debt service, which is why that increase in the debt burden is so important to the direction of the federal government. Because mission number one is don't get downgraded. Again, don't miss a payment. Don't see the United States lose its status as the safe asset. Because once we lose the status of the safe asset, we can ask the British how that happens and see the British experience in the late 1800s and early 1900s as the pivot point. But right now, I don't see that as a plausible scenario.
Yeah. Well, and you never, if I could talk like a trader, you never talk down your book. So if you have all these central banks that have massive dollars in their reserves, you know that it's just hot air. It's not, they don't mean anything. I will give you a quick book recommendation because it is related to crypto. So Michael Lewis, everybody's a fan of Michael Lewis, right? Moneyball and all that good stuff. He's a great writer.
Irish poker, yep.
So Going Infinite on SBF, Sam Bankman-Fried, published in the last year. I just finished it. Going Infinite, the title. It's fantastic because, like he does so well, kind of getting into the weeds and kind of the color behind what was going on in the platforms. Very helpful in terms of augmenting your concerns that you raised about currency markets.
Other questions out there? You can see better than I, Hannah.
We promise there are no dumb questions. There are only our dumb answers.
Promise I'm dumber than you. All right, you're on a trip. Your loved one takes you to like Tahiti, and you're sworn to not look at work. You're going to put your cell phone away, supposedly. And in fact, you get there, there's no Wi-Fi. But you discover in the lobby of the hotel, you can get Wi-Fi for like 12 seconds. What is your one indicator, your KPI, whatever barometer you like to say, all right, S&Ps are up, whatever. What is, all three of you, what is the one thing, if you have 7 seconds of glance, that you want to see on a daily basis?
One indicator.
One indicator for market health or economic health? Whatever.
Oh, I'll throw one out there. Dollar swaps among central banks. That's what I looked at as soon as I woke up and realized Japan was blowing up. That was the first thing I looked at. Okay, what are central? It's a way in which to measure a fear index. It's like a fear index. How bad are central banks needing to supply liquidity to each other?
I like that one a lot.
Let's talk more over.
Now I have to get something.
Can you say when it is, what time of year? When are we in Tahiti?
It doesn't matter. It's nice there year round.
It matters to me because, I may be looking at football scores.
I'll give everyone a simple one, and that's for market health, the VIX. That's going to give you a quick read on volatility in equity markets in a one single snapshot number and a level everybody can understand. I'm going to cheat and pick a second one. Right now, for economic health, I'm keeping an eye on the U.S. unemployment rate. The unemployment rate accelerates. I'm concerned about the economy. The unemployment rate stays within the mid to low fours. Smooth sailing.
Yeah, and I'll cheat and just say the S&P 500 because, even though it's not representative of all the markets, it's still what we all look to with respect to the capital markets. It's certainly equities. But great question, and I'm looking forward to Tahiti. Other questions? Back in the middle.
How big a risk do you think the real estate market is and valuations in both the real estate market and the private equity market, which seem to be being propped up?
Risk of the private equity markets and specifically real estate.
Real estate. I assume we're talking mostly commercial real estate with that question in the investment fund angle. How big a risk is it for the global economy, for the U.S. economy, and how big a risk is it for those investors in commercial real estate? I'll divide that into two answers. From a U.S. economy perspective, the potential contagion and connectivity of commercial real estate to banks, to lending and the like, likely equates to somewhere less than a quarter point of GDP. It's not a large drag the economy down into the abyss 07, 08 type of contagion. We've got better safety controls from a banking perspective to prevent that level of contagion. Now, within that answer, you probably can guess for commercial real estate investors, it is to steal a Charles Dickens, this is a tale of two cities. It's the good times and the bad times. It's good properties and bad properties from that perspective. And the individual real estate investor is going to be very, very careful about location, and terms.
And also remember, when we think commercial real estate, we don't necessarily need to go straight to office buildings, right?
Yeah.
I mean, think storage, think healthcare, think industrial. There's so much in that's offsetting some of the challenges within office space.
Yeah, good. Other questions from the crowd? People want to have a drink. We'd love you to stick around and have a drink with us as we'll have some past hors d'oeuvres. Really appreciate you joining us this evening. Thank you to our events team. Hannah, thanks to Eric Munger, who did a lot of the work here today. And thanks to all of you who are friends and customers. We really appreciate the business, and we hope you stick around and enjoy some time with us tonight. Thank you.
Thank you.